Good morning and welcome to our discussions on the financial accounting. We'll start a series of lectures on the business combination, the relevant accounting standards in India with respect to the business combination are the IFRS 3, Ind AS 3 for business combination, and AS 14, which is for the amalgamation. However, as we move along, we will also get into the accounting standards for consolidation. One of the important issues which these accounting standards talk about is the purchase consideration, and the purchase consideration is the amount payable by the buyer to the seller, can be determined on the basis of assets. So therefore assets minus the liabilities taken over is the purchase consideration on asset base. Or you can also determine the purchase consideration on the basis of earning, where purchase consideration can be present value of the free cash flows, or the purchase consideration can also be determined on the basis of the market price. So purchase consideration is equal to shares acquired into the market price of the shares. Okay, so purchase consideration can be determined any of these manners, and purchase consideration can be discharged either through cash or through shares or through bonds and debenture, or a combination of any of these methods. In a standalone balance sheet, in the books of the buyer, on the asset side, the shares acquired will appear as investment, and there will be reduction in cash if cash is paid, or there can be an increase in capital if the purchase consideration is discharged through issue of shares, and if the shares are issued at a premium, the share premium will appear, or the corresponding bonds and debentures may be shown on the sources side. So that means the effect on the balance sheet depends on the discharge of the purchase consideration. To understand this, let us take a simple exercise where A and B are two companies, and A acquires B 480 shares of B for a purchase consideration of 15,000, and the discharge is through the cash. So this is the balance sheet, and we want to prepare standalone. The purchase consideration is given as 15,000 and is discharged by cash 15,000. So in a standalone balance sheet of A, we are preparing the standalone balance sheet of A. So standalone balance sheet of A, this will not affect the balance sheet of B. So creditors will appear as it is, no change in the creditor, no change in the long-term debts, no change in the capital, no change in the reserves. However, the cash will change because you are making the payment by cash. Cash will reduce, no change in the inventory, no change in the debtors, no change in shares of X. Now shares of B will appear as the investment in the books of A, and no change in the plant. So therefore the changes that has occurred on the balance sheet is the changes in the book in cash and the corresponding investment appearing on the balance sheet. Okay, so in a standalone balance sheet, therefore the payment will affect the corresponding cash, or if the payment is through some other mode like shares or bonds or debenture, then the corresponding capital will change. But in this example, we saw that the asset goes up to the extent of the shares investment and the corresponding decrease in the cash flows. Now let us go back to the question and see instead of cash, the same question, if I say the purchase consideration is discharged by the shares of 5 issued at 50, that means issued at a premium, the impact will be, so case 2. Okay, case 2, purchase consideration is the same amount, but discharge through shares, discharge through shares, okay, through shares, discharge through shares. So the face value of the share is given as 5. The market price of the share is given as 50. So therefore there is a share premium of 45. So the number of shares to be issued, is equal to 15,000 divided by market price. So capital will increase by 300 into 5, and the premium will appear on the balance sheet as 300 into 45. So we'll see that effect now. So in case 2, we are seeing a situation for the same purchase consideration, the discharge is same, no effect on the creditor, no effect on the long-term debts. But if you see, the capital will change, because the capital, you are making an issue of shares, no change in the reserves, but a new item called share premium will appear, and the share premium will be 13,500. Okay, so let me sum it up. So the total of the sources side will be 71,000, and no change in the cash because the payment has been made through issue of share, no change in the inventory, no change in the debtor, no change in X share, by B shares will appear here, and no change in the plant. So unlike the previous one, in this case the sources side got affected because you made the payment through the issue of shares. So in case 1, the payment or the discharge of purchase consideration is through cash, whereas in case of case 2, the discharge of the purchase consideration happened through the issue of capital, and that too the shares were issued at a premium. So therefore purchase consideration may be same, but the discharge of purchase consideration can be through cash or can be through shares, or as we mentioned, may be through some other combination of bonds, shares and cash. So that means, if I take you back, so consolidation, the business combination requires a preparation of a standalone balance sheet, while the shares acquired will appear as an investment, and the discharge will decide about the effect on the cash or effect on the capital or premium or the bonds and debenture. In the next discussion, we'll see what will be the consolidated balance sheet of A. Thank you.